This is Benzinga Live. Spencer Israel and producer AB. What's up, everybody? How we doing?
Someone told me buy high, sell higher.
Let's get Matt Hammond on the show to talk some IPOs. Jake Wojacek from Trend Spider. We have a breaking news.
What is up, everybody? Happy Tuesday. Welcome back to another episode of Benzinga Live. We've got an absolutely packed show that I am very excited about today. Here in a few minutes, my good buddies Dillon and Ben from PeakBot will be joining us for some updates on their product. Then at noon, my man David Green will be joining us. We'll be doing some live trading with David Green. And then, second, guys, let me pull up my Benzinga Pro. And then we're going to have Lia The Trader on. We're going to have Gerber on at 1 p.m. So we're going to be going a little bit longer today than usual. So I hope you guys can stick around for that because Gerber is going to be talking about what's going on with Tesla, what he's doing there, as well as some other stock picks. So guys, go ahead and smash the like for, shout out to Sultan for helping us do some scheduling today. We're going to have Karl Douglas as well. At 12:30, Karl Douglas is a VC guy. He's going to talk to us about exactly what the implication of all this Silicon Valley Bank stuff. And then on top of that, just a crazy news day. I mean, today's CPI day. Maybe the first time, I want to say, in the last 12 months on a CPI day where it actually feels like not the biggest story out there. We're going to talk about the CPI. We're going to talk about that inflation reading and how the market is responding to it. As you can see here, let me go ahead and pull up my Benzinga Pro. We're going to go ahead and take a look at the SPY chart here. And guys, we're kind of ripping right now. I think a lot of people worried that, maybe this means the Fed's going to have to keep hiking, that the inflation's still at, 6% year over year, all these things. But I think bottom line, right, a week ago or last Friday when all this stuff was going on with Silicon Valley Bank, if you went on Twitter, you go out, people were acting like it was the end of the world. People were acting like this was the start of the 07, 08 banking crisis. I had Tim Melvin on here last Friday afternoon, and Tim basically said, hey, yeah, it's a big deal for Silicon Valley Bank. It's a big deal for a lot of these tech stocks and whatnot that have money there. But does it mean that, all of a sudden we're going to start seeing bank runs at your regional banks, at Comerica, at First Republic, at Western Alliance? And he said no. And I mean, yesterday the market seemed to think that was going to happen. You had FRC down about, 50% or all these things. And as you can see here, pulling up the daily chart on First Republic, this thing was a more than $100 stock just a week ago. Last Tuesday, it was $100 stock, and then it dropped all the way down. I wonder where it got to on its lows yesterday. Looks like 40. No, hold on. Let me zoom in here. We got all the way down to $17.50 on First Republic. It is roaring back today, up 47%. Now at $46. I actually got into this stock yesterday. I started buying some because I thought, all right, so let me try to explain this in the most layman terms possible. Banks will have, deposits and withdrawals. Silicon Valley Bank was facing an extraordinary amount of withdrawal pressure as, different tech stocks and VC startups, essentially were having trouble raising money, having trouble getting funding, and needed to go into their banks and pull out money, whether that's to maintain payroll, for different investments, for business expenses. Doesn't matter. Basically, all of these tech startups have had a very much hard time. A lot of them don't even make money. A lot of them are reliant on money coming in from investments, from VCs, etc. And that money had effectively dried up, meaning they had to go in and tap into their banking reserves. So Silicon Valley Bank started facing a bunch of withdrawal pressure because this is essentially the only type of companies that Silicon Valley Bank was working with is these high-tech growth companies that, again, don't already make money. That's a lot different than maybe companies that bank with First Republic or bank with Comerica, right? If you're like a cash flowing business, say you own a restaurant and you bring in 50 grand in profit every month and you're depositing that money into your local regional bank, you don't have the same type of pressure. You don't have the same need to go to the bank and pull out a bunch of money. Tim Melvin basically talked about the biggest risk is that Silicon Bank collapsing led to fear that these other banks would start collapsing, and then those would cause bank runs at these other banks. And obviously yesterday the market thought this was a possibility too, and these bank stocks were getting absolutely crushed. But you had the FDIC, you had the Fed, you had the Treasury step in and say, no, everyone that deposited money at Silicon Valley Bank is going to get 100% of their money back, and it's not going to be months or months down the road. Their deposits will be made available ASAP. And I think that helped, squash a lot of fear that people were having. And really, if you look at the, First Republic Bank, Western Alliance Bank, they don't have balance sheets like Silicon Valley Bank did. They don't have the same problems that Silicon Valley Bank did. There would be no reason for different companies to go and all of a sudden pull all their money out. I do think there's probably a lot more companies that are going to start looking at holding a lot of their treasury and things like T-bills, especially right now with the high interest rates. It's not the worst thing in the world to just do that and get the free 4.5%, 5% or whatever. But 2 years ago when interest rates were at zero, you had no reason to do that. And if a bank said, okay, we can get you a little bit more money than what you can get on the, through treasury bills, you had no reason not to. And so people that are like, oh my God, these companies were so negligent, they held more than the FDIC. That is so silly and such a bad take because, first of all, Silicon Valley Bank is one of the, it is the premier or was the premier bank in this space. So to act like some company was stupid for having millions of dollars at Silicon Valley Bank is silly. And in hindsight, I mean, the bank screwed up, they failed, and those companies are getting their money back. So I don't think, it was like negligent of Roku to have a bunch of money at Silicon Valley Bank. What were they supposed to do? Buy T-bills when interest rates were at 0%? That's where they got all this money, is 2 years ago when, interest rates were at zero and these things were going on. So, got it. All right, I see our first guest hanging out backstage, and since we have such a packed show, we got to keep things ticking. So without further ado, gonna go ahead and give Dillon and Ben our very special Zinger Nation welcome. When we come back, we'll be talking about PeakBot and some new developments in the platform since last time we had them on. So without further ado, let's go ahead and give them that intro, and we'll be talking some automated trading when we come back. Ben, Dillon, how is it going? Welcome back to Benzinga Live, I should say.
How we doing, Aaron?
It's Aaron.
I am good. Have you guys been following all this, Silicon Valley Bank fiasco?
I mean, how could you not?
Don't have a choice.
Everywhere you turn, you see it.
Yeah. What? Do you guys have any thoughts on it before we get into PeakBot?
Hey, I think that
Dillon was very quick to defer to Ben there.
He sure was. We don't like talking of anything that could be interpreted as financial advice. But no, I mean, my opinion is, like, whenever we see something like this happen in the economy, there's always a bunch of losers, but there's also a chance to become a big winner. And Aaron, you said that you just got in on whatever that last ticker was that you had up on screen. So hey, maybe you're one of the big winners this time around. So where there is call it destruction, there's always opportunity on the other side.
Yeah, and I think people were quick to, I don't know what it is. Right now, it just seems like a very polarizing time in the overall markets where a lot of people are still super, super bearish, think there's going to be some huge crash. And I think a lot of people pointed to that as like, see, here we go. And yet the market, I mean, yeah, I think SPY closed down like 2% or maybe a little bit more on Friday, but then was pretty flat, a little bit down yesterday, having a good day today. So it's like clear that the overall market isn't as worried about this whole situation as, some people out there are. Yeah. But all right, Dillon, Ben, let's get into the real, what I brought you guys on and talk about. PeakBot before we get started, can you give us a quick rundown on what PeakBot is? I mean, I know you guys have been on before, but we might have some new members in the audience.
Yeah, absolutely. Ben, maybe I handle more of the surface level and I'll let you nerd out later.
Yeah, go for
Thanks
it.
so much, Aaron. So yeah, just to give a quick flyover of PeakBot, PeakBot is an automated stock and options trading platform. We're integrated with TD Ameritrade, so the largest retail broker. What we're doing is we are setting up a system to where the everyday person, the retail trader, can put a stock trader in their pocket, right? So we're not financial advisors, as Ben mentioned earlier. So we do need about 5 to 10% participation to do this, meaning you pick the stocks, our bots do the rest. So we're in the game of stocks and options trading. We're not necessarily in the world of crypto or futures or Forex. We've taken well-known manual trading strategies, simple, if you will, all things considered, and we've automated them. So we have a subscription business, but more importantly, we want to make this easy to use, affordable, and accessible. So home of hands-free trading. We're just trying to provide access to the everyday person.
Yeah, and I think what's really interesting about this is, this is something that essentially is done on a huge scale every day by institutional investors, by quant trading firms, whatever, and yet there's not a lot of accessibility to do it, as you said, just for everyday investors. So can we go through essentially like who maybe this product would be for and maybe who it wouldn't be for?
Yeah, Ben, I'll take a quick stab at this and feel free to add.
Sure.
We like to think at PeakBot, truthfully, that this is built for the new trader and the active trader alike, right? Because we're kind of plugging into different strategies. Anybody who's looking to save time while eliminating fear and greed, right? They're too busy. They have their day job, their 9 to 5. They have a family, their social lives. Nobody has the time to stare at a stock chart all day. So maybe it's the individual with $2,500 sitting in their savings account and they never really, dip their toe too much into stock trading and they want to give this a try. All the way to the advanced trader who maybe is spending more time in front of their computer, but no reason PeakBot shouldn't be operating for them on the background on some of these options contracts and swing trading on our momentum bot and etc. So it's a wide range. Ben, would you agree with that?
Yeah, and maybe I'll just add maybe who it's not for. It's not for day traders. So our algorithms are not executing day trades. We want to be cognizant of the pattern day trading rule. We don't want to ban any of our users from TD Ameritrade for 90 days because they broke that PDT rule. It's also not for people that would necessarily enjoy sitting in front of their screen and manually trading all day. Like we have had people try to use PeakBot as a supplement while they were manually trading. And, with automations, there are certain guidelines that need to be followed. And it was just interfering with their normal strategy. So if you're someone that's able to, trade full time for an income, then maybe PeakBot could supplement in some way. But we found that this is really for people working full-time jobs. They don't have the chance to make trades during the day, but they still want to be active.
Yeah, I think that's because some people, right, are trading because they want extra income. Some people are trading for the love of the game, right? Like they want to be in front of the screens reading charts and doing all this on a day in, day out basis. So it's one of those things to me that it's for each individual person, case by case basis. Look at it, see if it might be right for you, and you want to try it out. You don't have to, do it forever. But I want to get into, because I know there have been some developments in terms of specific products available since the last time that I had you guys on. Can we go through some of those new things?
Yeah, absolutely, Aaron. And I saw some questions coming through on the comments. If you wouldn't mind, I can just kind of answer those really quick. Somebody had asked Calvin, I think, if our bots integrate with Charles Schwab. So right now we're integrated with TD Ameritrade. Obviously, there's a merger there that's happening. So we believe in the future, on the front end with Charles Schwab. potentially. Right now, it's just through TD Ameritrade. And then for a track record, we're one of the only algorithm providers out there who provide a full list of our traders' results. You can go to our website, use peakbot.com, click on our results tab, and you'll see all of our traders' weekly average returns on our momentum bot, which is our swing trading equities bot. So anyway, I apologize. So I can kick it over to Ben in a second here. The newest bots, Aaron, since we've last had us on, we were only live with our momentum bot, which is our flagship product as we launched. However, we've now introduced 2 automated option strategies, the wheel and the iron condor. Now, what's interesting about these strategies is this isn't just our logic, right? We kind of reinvented the wheel, pun fully intended. So I'll let Ben kind of talk about that a little bit more with what we're doing here with selling cash secured puts and covered calls.
Cool. Yeah, and Aaron, looks like you're pulling up maybe the results tab if you want to. But yeah, so like Dillon mentioned, we added the wheel, we automated the wheel, and we automated the iron condor. Now, in order to keep things simple, we are staying in control of the strike prices that we want to execute on. And the only inputs that anybody has to put in are they just have to select the bot they want to trade, they select the stock that they want to automate, and then they select the number of contracts. In this case, because these are options bots, they select the number of contracts that they want to automate. And those are really the only inputs. So I'll talk about the iron condor briefly first, and then I'll get into the wheel, and we can get more in depth maybe there. But the iron condor, I don't know, Aaron, how deep do you want me to get into the iron condor? We don't have to get too technical.
I mean, give us the base overview. I mean, I know a lot of our traders here watching, do different option strategies and may be familiar with an iron condor, but maybe not everyone is. So
sure.
So, yeah, and really quick, sorry, Ben. Aaron, I have my screen if you want to share it just to show a little bit of the iron condor and what it looks like on our app here. Sorry, go ahead, Ben.
There you go.
Cool. Yeah, so the iron condor, what it does is it sets up a call spread and a put spread, and we determine where to set those spreads based on a certain delta. Now, Aaron, last time we were on, we were heavy on transparency. We're still heavy on transparency. We want to be as open as we can be for everybody to see. So where we set our strike prices for those spreads depends on delta, and we're looking for a delta of a plus 0.15 delta on the call side, and then a negative 0.15 on the put side. And then we'll hedge those spreads by $1. So the most you would ever lose is, $100 on one contract for an iron condor. So what we'll do is we'll set you up on Tuesdays and Thursdays around 11-ish, 12-ish in the morning with a 1 day till expiration iron condor. So we want this to be frequent. We want this to be income generating. So that way you can get in and out of 2 positions each week. And then what we have built in is an automatic adjustment that takes place if the stock price breaches either the call spread or the put spread. We've got an adjusting entry in there to bring the spread that is basically worthless at that point. So if the price is rising, we'll close out the put side, and then we'll bring the put side up to and match where the strikes are on the call side. And that's where we'll have that adjusting entry. So we'll still realize a bit of a loss on that trade. However, a little bit less of a loss because we hedged just a bit. So based on those deltas, historically and statistically, you can see roughly an 80% win rate on the iron condor. And then our wins are about a third the size of our losses. So taking bigger losses, but we're winning much more than we're losing. So net out that math, and per contract that comes out to about a $17 win per contract. So depending on tier, you could trade 5, 10, or 30 contracts on the iron condor at one time.
Yep.
So that's the iron condor. Want to hop over to the wheel now?
And there was one question that came through, Ben. It said, do you have a verifiable P&L based on that method? I don't know if you...
So it's unfortunately a lot more work than you'd like to imagine, putting together these P&Ls for all of our users. We do have that, as you saw on the results tab, for our momentum bot. It's actually on my to-do list this week to put together the P&Ls for Iron Condor and for Wheel. There's a bit more at play there because you have to factor in premiums and you have to factor in assignments if assignments do take place. So that's what makes it a bit tricky, but that's on my roadmap for this week. So Rich, we'll get back to you on that, or just tune into the results tab next week. Hopping into the Wheel, this one is great. I just love how the Wheel can just continuously print out these premiums, and you can choose to reinvest or you could choose to set aside. Dillon and I were talking about it yesterday. And we kind of use like a mortgage analogy, which maybe we'll get to in just a bit. But what we're doing with the Wheel, and I'm assuming that we're going to come into the Wheel not owning any shares, because there's two sides of this, as you'll see in a second. What we're doing with the Wheel is we're selling a cash secured put. So we'll start you off by selling a cash secured put with a weekly expiration. So on Mondays, or if the market's closed on Tuesdays, or if you don't get your stock picks in time on Mondays, you can do this on Tuesdays as well. But for the sake of this conversation, let's say on Mondays, we'll open up a position for you. The Wheel will open up a cash secured put, or it'll sell a cash secured put on your behalf. And the strike that gets executed, again, is dependent on delta. For the Wheel, we look for strikes that are nearest but greater than a negative 0.25 delta to get you in on that cash secured put. And then on the flip side, the covered call will just be a 0.25 or less delta for that strike on the covered call. So what happens is we will open that cash secured put for you on Monday. It's a weekly expiration contract, so we'll let it run all the way through until Friday. You'll keep that entire premium. No matter what happens, you keep the premium. Now, on Friday, whatever strike you sold, and wherever the stock price is, that's going to depend, or that's going to dictate what the next steps are. If the stock price is greater than that strike price that you sold for the cash secured put, nothing's going to happen. You're going to keep your premium, and then next week you're going to just sell those cash secured puts again. Now, if the stock price is below that strike price, then you're going to get assigned those shares. You're going to be forced to buy 100 shares per contract on whatever price that strike was at. And then next week, you're going to own those shares. So we're going to start selling covered calls. And then it's really, the name of the game is just collecting premiums. And you run this over a certain period of time. Ultimately the premiums that you gain, regardless of the gain or loss on the assignment or calling away of shares, the amount of premiums you receive are going to eventually equal the amount of capital you had to set aside to run this strategy, which is the part that I love about this. We're targeting 0.5% or a 1% return on the cash you needed to secure each week. And I mean, if you look at that over time, based on a 1% return each week, after 100 weeks, you've essentially made back your entire investment in premiums alone. So we, I guess I'll pause there, Aaron, before I get into like our watch list and stuff for that. Do you have any questions there?
I see a couple good questions coming in from the chat. So it's someone's asking, Deuce Parker saying, so if that stock goes down 10 points below that put strike price with your long stock, you lose twice as much. I don't know if he's asking that or saying that. Robert saying, can you please show the actual interface so we see how it looks integrated into TD Ameritrade? Are you able to do that?
Yeah, I can pull up my screen here and show you what it looks like on the PeakBot side of things. And then, yeah, give me 1 second.
Yeah, so Robert, it's a web application, so it doesn't interface directly onto TD Ameritrade. But yeah, Dillon, go ahead, pull that up. And then
Aaron, I got to share.
Show how you could set up the Wheel. And then Deuce, to answer your question, so yeah, we definitely have to be cognizant of, if the stock continues to go down, are you going to get stuck with that? And sure, a collar might be a solution for that. But the way that we see this is, let's say you set up the Wheel with $10,000, and $10,000 is your initial investment in the Wheel, right? You're going to be spreading that $10,000 across a few different stocks and collecting premiums on those stocks. Now, let's say that the market tanks, kind of like it did at the end of last week, right? You're going to get assigned those shares, and you're going to see a huge decrease in value in your positions. However, that's not necessarily going to change the amount in premiums that you're going to earn each week. So depending on the stocks, the volatility of the stocks, the options liquidity, you're going to earn a certain amount of premiums each week. So while your initial $10,000 investment might be worth $8,000 or $7,000 this week, you're still going to be earning those premiums. And then over time, you could get assigned shares, and maybe your covered call is higher than the strike that you bought at, and you might realize a gain. But if you kind of look past the gain or loss, and again, this is thinking 2, 3, 4 years of running this strategy, the gain or loss on the actual transaction of buying and selling the stock isn't going to matter as much as the total amount of premiums gained during that time. So just like buying a house, you could buy a house, let's say for this example, for $10,000, and then over time that house will fluctuate in value. And let's say it's a rental property, you're still earning that rental income. Then over time, that rental income that you earn is going to amount to the amount of money you have to put in upfront in that upfront investment. So that's kind of the way that I like to look at it, that over time, we're going to make up in premiums everything that we initially invested.
You need 2x your money. Ben likes to be careful. Well, it's not that cut and dry, but what he's saying is, given enough time, the amount of money that you'll collect in premiums will eventually match what you set aside for this options contract. And I can show you what that looks like in a second. But, for the example of, you're going to collect a $10 premium every week, regardless of which side of the wheel you're on, $10 a week for 100 weeks, depending upon your position, again, this is a long game. It's a real set it and forget it. So this is what the actual interface looks like. So this is app.usepeakbot.com. So it's a web-based app. We're not going to be found in the mobile app store, but you can utilize PeakBot on your smartphone. Just save it as an icon to your home screen, whether you have an iPhone or an Android. So it's applicable on both desktop and mobile. But the whole concept here is we want to make this incredibly simple, right? It's all about the ease of use and the kind of the user experience here. So this is your automated portfolio. I currently have 2 bots set up on my portfolio. I'm not using momentum due to this volatile market that we're in right now. But if I wanted to get started, and again, this is where you're connected to your TD Ameritrade account. So this is your broker integration screen. It's got my wife's info off on it, so I'll get off that screen. But so this is where the magic happens. This big activate button here, you come in here, and in 3 steps, we want you to be able to automate your position. So 1, select your bot. 2, select the stocks. Now we have our watch list here. This is, again, can be found on our website. So let's just say I'll add this DLO. So you have the estimated strike, the cash needed, the estimated premium paid, the estimated return, which is just based off of the premium and cash needed, and the current stock price, which is updated every 30 minutes here on this list. So I'm going to choose DLO. I'm going to come in here. Now I can search by the name of the stock or the stock ticker itself. So add that in here. And now I would just determine the number of contracts that I'd like to enter. And PeakBot's going to determine how much cash I need available in my account to secure this contract. So
got it.
If I click 2 here, you'll see the number change. Down, if I went back down to 1, it would stay here. So I'm going to hit activate. I'll hit I agree. This is just a confirmation screen. And from here, you'll notice that my budget in bots has jumped up from roughly, I think it was just over 7,000 to about 8,400. And now if I come back down in here, I'll see that my DLO is now active, which means...
And those are just rough estimates of how much cash. We put a little bit of a buffer on it so that way people don't overextend their accounts.
Yep. So don't get hung up on the numbers. Sorry.
All right, well, guys, we're running out of time here, but I implore people to at least go check it out. Go to use PeakBot, see if it's right for you, and you can always start small, see if it's working for you, if it's not. But like I said, I mean, it's cool to just have some of these things available to retail traders. Because look, if the big boys are doing it, the institutional guys are doing it, then it's only right that everyday traders also have access to something like this. So good on you guys for going out, creating something and doing all this work, because that's way above, you know, what I'd be able to do right now. So congrats so far on getting the platform launched, and hope we see you guys at more of our events in the future. I know you guys had fun in New York at the FinTech Awards. So
Yes.
you know, of course we'll be doing that again later in the year, but maybe before then we'll find another time to reconnect.
Amazing.
Awesome.
Aaron, thank you so much for having us. Real quick for your listeners, we're going to go off and create a discount code for 50% off for anybody who's listening to this show. The code, Ben, what do you think? BZ Live? Something like
We
that?
have one from last show. It's just Benzinga in all caps.
Okay, Benzinga, all caps. We'll make sure it's extended, but that's a code for 50% off. And remember, 2-week free trial for anybody that with a TD Ameritrade account. Just go to our website and get started today.
Hell yeah, I got the code in the chat, dropping the link as well. Use peakbot.com. Dillon, Ben, thanks again for hopping on the show. We'll chat soon, okay?
Thanks
Aaron.
so much, Aaron. See you at the Peak.
All righty, y'all. That was Ben and Dillon from PeakBot. Again, link is in the chat. Go check that out. Use the code Benzinga if you are interested in trying it out for 50% off. We got to keep things ticking. I see my man DG, David Green, hanging out backstage. So without further ado, let's bring my man David Green on, see what he's been trading, see what he's been lost. Dave, how's it going?
What's up? What's shaking, Aaron?
Man, I'm jealous. You got a nice tan going. You were on a cruise. You're down in Florida. It's still cold and snowy here in Detroit.
It's beautiful down here. Thank goodness.
I'm pulling up
Okay.
your screen. What are we watching today? You trading the bank stocks? You trading?
Well, let's talk about what's been going on for the last few days. First of all, obviously the shit all hit the fan. Pardon my language. On Friday. What's up, Tiny Pie Media? And you know, I go on all the social medias, the TikToks and the Facebook and the Instagram and all that stuff, and there could not have been more people spreading fear on Friday night and Saturday than I've ever seen before in my life. And of course, I had to make a video on it and respond to it a little bit. And look, I don't claim to know what the market's going to do on a daily basis, up, down, or sideways, but that is so irresponsible when people come on and do that. And, you know, I made a follow-up video today saying, I guess the whole market didn't really fall apart, did it? Matter of fact, we're, I don't know, 100 handles off the lows that we hit that day, which when we hit the lows that day in the spiders, we had basically almost exactly given back all the year's gains, right? When we got down to here, it's about where we were in January. We gave back all of the year's gains. And, you know, we're traders, right? I'm a trader. It just set up for some unbelievable trading opportunities. And some of these stocks that, you know, people just thought were going to go out of business, the FRCs and the PACWs, and there was a whole bunch of them. You know, whether they're going to get bailed out or not, Jay, it just, whenever I see something like that, it's just so irresponsible. I've been through this, I don't know, 100 times in my 30-year trading career. And I'm not saying to touch any of these stocks long term, because I wouldn't, and I have no idea what's going to go on. But, you know, last week we were watching FRC when it was $120, and we bought a put in it for 20 cents and sold it for $14. Next
Holy
day,
cow.
Yeah, we made like 7,000% on it. And it went to $50. From 20 cents, that put went to $50. Obviously, we didn't gain all that. But some of these other ones have just set up for great trading opportunities, and that's what we do. So, you know, 5,600%, whatever it was. In my 35 years of doing this, I've seen 1,000 of these events, and especially for you guys who are younger, and I'm not saying these stocks, not the bank stocks, whatever, but the overall market, what's up, MD, has gotten through every single one of these things and has done nothing but go up over time. So, you know, usually when you see people coming out and telling you it's the end of the world, it's the time to start buying the market and the good stocks in the market, right? A lot of these stocks, NVIDIA, Tesla, Apple, all got smacked down on you know, those supposed things. And if you bought good stocks, you did nothing but make money even over the last 3 or 4 days, right? Tesla went down to $164, set up for a nice trade, back up to whatever it is, 181 we are now. And we had an actual pivot point in that the other day. Let me see if I got it on my daily chart. Yeah, here it was. Check this out. All right. So again, as traders, these are the things that we look for. If you guys can all see this little green dot down here, that was exactly $164. That is exactly where it hit technically that day, and it's up 17 points from them. I mean, me and you are in the same camp on this, Aaron. Whenever you see stuff like this happen, it's certainly not a time to panic out and sell. And again, in the good stocks. I don't know. What have you been doing lately? Anything?
Well, I bought some First Republic yesterday when it was down 50%. So I had last Friday on the show Tim Melvin on, who's like a regional banking expert, and he basically explained to me in very good terms about, yeah, this is a big deal for Silicon Valley Bank and their depositors and stuff, but the problems that Silicon Valley Bank was basically all these companies that are high tech or high growth tech startups and stuff where the money's really dried up from investments. They had to go in and tap into their bank reserves. And so Silicon Valley Bank was facing a lot of withdrawal pressure, but he was basically like, that doesn't mean, First Republic, who might be working with a lot different types of companies, all of a sudden is going to experience a bank run and all these things. So, I thought a lot of the people freaking out over this was a little bit overblown. And then, of course, you had, the FDIC and the Fed and the Treasury step in and say, okay, we're going to, make sure everything is whole and make sure depositors are. And people get mad about that. It's like, what do you want them to do? What do you want them to do? Let all these.
They want them to bail out their horrible investments that they made. In my mind, as long as they make the people who have their money in the bank whole, that's all I give a crap about. That's it. If they're going to be irresponsible and buy bonds at 5% and sell them at 1.8% because they had to raise money or something, well, guess what? They made a bad trade, right? There's no crying in baseball and there's no crying in trading.
So from what I understand, they're essentially letting the bank fail and then making sure the depositors are whole. That's like best case scenario, right?
I agree 100%. And the fact that these guys sold stock a week before and then gave all them and them employees bonuses on the Friday when this was happening, to me that's criminal. That's
yeah,
horrible.
and you had I actually wrote an article about this today. Adam Schiff, a representative out in California, is drafting a bill to try to go after these banking executives and get some of that money back because, frankly, pardon my language, that's bullshit. The guy sold $3 million worth of stock last Friday on like February 27th or 2 weeks ago. There, of course, he knew there was this huge hole in the balance sheet, and so either way, it was a problem, I think, that was specific to Silicon Valley Bank, specific to these high growth tech companies. That interest rates have risen to a point where now VC funding has dried up. But the example I gave earlier is that if you own a restaurant and the restaurant's making $50,000 in profit and you're depositing at First Republic or banking with Western Alliance or whatever, you don't have the same withdrawal pressure. You don't need to go and withdraw all your money because you're not all of a sudden like having trouble paying payroll and all these things. So, to make it seem like there was gonna be all this contagion and stuff, I think part of it was the guys, they wanted to make sure there was gonna get the money full, and so if they make people freak out, I don't know all what was going on, or if these. The thing that really irked me, Dave, was just going on Twitter and whatnot and seeing everyone freaking out and seeing people that don't really know what they're talking about try to say why this is the end of the world and stuff. When I was sitting here being like, look at the market. Like the market's like, you think you know more than the market. The market's not going down that much. Like the market was down 2% last Friday, down a little bit yesterday, and now up today. Like, does it really look like this is the start of an 07, 08 type? Crash?
It's not only is it not, you have to think, and again, nobody knows. The Fed, I just can't see how the Fed can be as aggressive as they have been now with this going on. I wouldn't be shocked. I wouldn't be shocked if they do nothing next week and say maybe we're going to put the brakes on for a little bit and see what happens here. I don't know if that's what's going to happen, but I think if they do that, that leads to a rally from here.
Right, and so Robert Silva, let me address this comment real quick. So. The withdrawals were coming for SVB, again, because they already were facing withdrawal pressure. Because, again, if you're, a high-growth company, I don't know, I'll use like Roku or Sunrun, for example, two companies that we're banking with this stuff, and you're running out of money because the investments are slowing down and you're not a profitable company yet, you got to go to the bank and pull some money out. As that happened, Silicon Valley Bank's hole in its balance sheet grew because of this terrible bond trade they were in. And then Silicon Valley Bank went out and said, okay, we're trying to raise money to essentially fill this hole in the balance sheet. That was the tip-off that a lot of companies got. What do you mean you're trying to raise money? You're a bank. What do you mean? And so then they started going, and then it was, fear begets more fear. They all started going it. But again, my point is that those problems were specific to this certain industry, to this certain bank, and does not necessarily mean there's gonna, all these other regional banks are going to fail or whatever. The only way that happens is if different types of companies outside of tech, outside of growth stocks, go to their regional banks and say, okay, now all of a sudden I don't trust you because of Silicon Valley, which I don't think they would really have any reason to be completely honest.
No, I agree with you 100%. And I even saw people coming out and saying this is horrible for the entire tech industry. Like Apple was going to get killed on this, and NVIDIA and Tesla. I mean, look, usually when I see stuff like that, it's always a counter indicator, and it's from people like you said, Aaron, who have absolutely no clue what they're talking about. Yeah, we were talking about the VIX a minute ago. I mean, the VIX went up 40% in 3 days, right? It went up from 42 to 60. That's 35, whatever percent it is. It just got completely way overdone. And when you see stuff like that, usually we're going to get a pullback from that 99% of the time. So I don't know. We've just been, we've been trading. Chuck Schwab is the one that we looked at, and I'll tell you exactly what we did. And of course, we post all the stuff we do and stuff. But when this thing, because I didn't think Chuck Schwab does not have exposure to the things that they do. And it could be a long time before this recovers also. But this day, when we got smacked down here, right, we sold 44 puts and we sold 40 puts, meaning that, like when your guests were talking about before I came on, that if it would have went below, I think 42 and 40. If it would have went below 42 and went below 40, we would have been long the stock. But we felt there was very little risk of that happening. And guys, what do we get on those options? I think we got like $2 on one, $1.50 on the other, and they're completely worthless today. Yeah, one was $2, one was $1.40. So, Chuck Schwab was just thrown out, again, thrown out with the bathwater. So we always look at these as opportunities, especially from a trading point of view. What did FRC get to $17, something like that? And this other one, PAC-W, got to like $5. I mean, some of those things were insane. And sometimes when it looks the scariest is when you got to strap them on a little bit. And, at least at that point in PAC-W, you knew you could only lose $5 from where it was, right? So this is going to take a little time to sort itself out, but it certainly is not a game changer as far as the overall market is concerned in any way, shape, or form. And none of these events usually are. Yeah, Bank of Hawaii was another one, right? It went down to like, I don't know, $17. It's back up to 60, whatever. When things like this happen, we just look for trading opportunities. Long term, I think we're all going to be fine. But for us, and all I do is day trade, right? That's my concentration. We're day traders, we're swing traders. I had a big call, Aaron, for a lot of people in my room who don't have, the 25K for the PDT rule, doing a lot of options, and now we're trading the E-minis and the MES. So we've opened up our room to a whole new group of people who don't have that, the 25K PDT rule, and now we're trading these other things too. Hold on, putting Boeing out small on the 65. Let me just take a look. Maybe we get a live trade set up. 209.02. I like it, Boeing. Let's pop a little order out. And what we're doing in the room, Aaron, all we do is trade all day. We look for opportunities. We trade.
I mean, I still wouldn't really, I guess, okay, here's the only thing that I would say why, if a business, instead of then, like right now, a lot of businesses could just buy T-bills and get a decent percent. So like there'd be ways to put money in assets that are fully insured outside of a bank right now. But again, I just couldn't imagine. I mean, I saw some people saying like these companies should have spread out their funds 250,000 at all these different, like, that is so silly. Like, these people, again, like, it just was so frustrating, Dave, seeing everyone, because I mean, I get it, like, social media, people want to talk about what's hot or whatever, but people that really don't know what they were talking about, like a big company like Roku is really going to have $250,000 at 1,000 different accounts at different banks.
No,
Like, no, of course not.
And the Fed is never going to let this, and we're not paying for this. A lot of people even came out and said, oh, we're paying for this. This is a bailout. This is not a bailout. This is not coming from taxpayer money. It's just making sure that anybody who has money in these banks gets all their money back, and the government is paying for it. So I've seen a lot of people come on too and said, oh, we're going to pay for this. It's coming out of our taxes. No, it's not. It is not coming out of our taxes. It's a completely different ballgame. I saw a good question from Jay. After all the effect, DG, I bought a bunch of these bank stock yesterday. What are you thinking now? I'm thinking now that we just used them as a trading device, Jay. And what I would do is be buying some protection if you're going to stay in these things. If you're long, sell upside calls. It'll limit your profits, but at least you'll be protected. God forbid something happens again on the downside. So for me, I'm not in any of these long term. We made our trades in them. I was never in any of them anyway. We made our trades in them, and I'm just looking at again to trade these things every day. That's all. The bank pays insurance that gets passed down to the customers. All right, maybe it does, MD. I'm not an expert on the whole thing. Everyone knows everything. You don't know until you have been in these trenches and actually have a minute. Rich, listen, I'm the first one to admit I'm doing this 35 years. I have no idea what this market is going to do on a day-to-day basis. I don't. All I know is when I see things like that happen, I want to buy good quality companies and then take advantage of some of these insane trading things that we see. That's all. I hear what you're saying, but no big besides Roku had money. They knew they were shaking. So maybe they did a lot more due diligence, Jed, and they were smarter about it. You know what I'm saying? Go Rangers. Shut up, Silverman. Roblex had $4 billion. There you go. Did they have that much? $4 billion?
Yeah, and I mean, everyone's saying like all they were uninsured, the funds over 250. I mean, but which I know technically they were uninsured, but in hindsight they kind of were insured, right? Because the government stepped in and made sure they were all whole.
Yeah, exactly, 100%. Yes, and that's what you should be doing. Let's see. Serious question. I was short a couple of shares when SIV bought. Now I'm a bag holder. You're not a bag holder, Weezy. If you were short that stock, you are not a bag holder. That's a good question. You know what, Aaron? Maybe you know this, okay? Because I don't know how this works either, right? If the stock never opens again and it's just gone, what happens to all the options that were traded in it?
They're done, but typically, I don't know if this is going to happen with Silicon Valley Bank, but a lot of times companies going out of business, like the stocks will open back up, and a lot of times like you'll see a little run in those stocks. I don't know why. It's just people taking on speculation and stuff. But again, I don't know. I don't think that's going to happen with Silicon Valley Bank. And I don't know. I mean,
whatever it was, HSBC took over some of their assets or something, whatever. I don't know if you'll be going into a lot of people have asked me this question. I have somebody who sold a put in it. I put them long at $89. So what happens with that? Are they ever going to put them to stock at $89?
They bought puts on an
SIVB stupidly because they thought it was going to be okay.
Oh, well, then they should be happy that they're not.
Well, that's what I'm saying. Did they ever get put to stock at $89? How's that work? I don't know. I don't know if you were short the stock, if you get paid. I have no idea. But that's a great question for options holders, right?
Yeah, I feel bad for anyone who bought puts on Silicon Valley Bank and now they can't make any of that money.
Yeah, exactly, 100%. Well, when we saw that happen, we went right into. We have a great banking analyst in our room who actually has a banking analyst that's one of his best friends. And like you, Aaron, he came on Friday and explained exactly what was going on in a lot of things and told us, a couple, no inside information or anything, But, picked out an FRC and a couple other ones that could be in the same position, and that's why we got into an options trade.
Got it. Well, what about other names you're watching right now? Anything in particular?
No, all of our usual suspects. We're just trading. Boeing, NVIDIA, all the same stuff. I don't have anything special on my conviction or lack of conviction list. I think today's probably over. What do we got? PPI coming out tomorrow, I think. We got some PPI tomorrow, and then, of course, we got the Fed next week. So, I don't know. I think we kind of slow down a little bit between now and next Tuesday, or I think Wednesday is when they actually come out. And just trade your little tushies off. And in this market, when we get into a trade, obviously we always sell some for a profit. We hang out, get our stop orders, and try to get as much out of our winners and the least out of our losers. Yeah, Myrna's coming in a little bit here now. Yeah, I think it's a triple witch Friday. Myrna could show a little support down here at our 65 EMA at 150.91. Might be something to look at during lunch. Look at the volume and everything, though, guys and girls. This is why very rarely do we ever trade during lunch, because there's just no volume in anything. It's all gone. It's just Deadsville here, so we're not going to do any.
How's your boy Pete doing?
Oh, Pete is doing spectacular. If you start looking at some of his pictures, yeah.
Well, the reason I ask, one of our next guests coming up, Lia. I saw pictures on Twitter. She was with Peter earlier
Lia
today.
The Trader. I know Lia very well.
Yeah, it doesn't look like she's
coming on next. I'm gonna hang out.
She's backstage, but it doesn't look like she. I would pop her on right now to say hi, but it doesn't look like she's there right now. But she'll be on in 15, 20 minutes with us for a little bit.
Excellent. I'll hang out and watch. So one thing I want to talk about, Aaron, if I can, is tomorrow night we have our monthly webinar, and we have over 1,000 people signed up, which is our biggest one yet. And I think a big reason for that is because what's going on in the market. And I think the biggest problem a lot of people have, and not your guys, because you guys know what the heck they're talking about, but they're going into this fear mongering and getting caught being long, getting caught being short, and they're just getting burnt. So, our mission is to help all the retail traders. We have over 1,000 people registered tomorrow night. Go to WSGTA.com. If you don't mind popping that up there to register for tomorrow night. We are going to talk money management, trade management, psychology. I'll get into some of the technical analysis that we use, show you all the technicals we use, talk about some of our trading setups. It costs absolutely 0.0, and we usually have a good time when we do this. So, yeah, we have over 1,000 people. WSGTA.com, guys, come hang out. Doesn't cost anything. We'll answer all your questions, and hopefully we help out a bunch of people tomorrow night who are struggling with this market. AMC's halted again. What did I tell you about AMC? Oh, no.
Wait, the downside or upside? I haven't even been paying attention to AMC.
They're issuing more stock, someone's just telling me. There's another guy, in my opinion, it's just a Ponzi scheme. Whatever.
Adam Aaron?
Yeah, he comes on all the time talking about, I love the retail traders and blah, 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 blah. How many times have I been on with you guys and tell you this? They have $6.5 billion in debt. They're never going to pay down. Less people are going to movies now than before the pandemic. And still a lot of, don't you see this one every day, Aaron? I don't know if you do or not, but I see it every single day. People on there, I'm buying more. Here comes the major short squeeze of all time. It costs so much money to borrow the shorts, and look what happens. Let's see. AMC Entertainment shareholders approving common stock share, 8 converted to common shares. Yeah, but are they going to get the reverse split? That's my question.
Well, I appreciate you. I appreciate you, Dave, because I get a lot of guests on that. I have a feeling they don't even share their real candid thoughts on AMC because they're scared of how people react. I know you're not scared to say what you think. And by the way, Dave, I mean, if you think Dave is just some huge bear, whatever, I can pull up clips from when Dave was buying AMC long when it was running, when it was just a trade. He's willing to say what he thinks and be nimble, and that's what you have to do in these markets, right? Be long when it makes sense to be long, and be short when it, you don't even have to be short. Just don't be dumb and go out and be buying AMC just because people are telling you to.
Everybody do whatever you want. I don't give anybody financial advice ever. Yeah, the one time we traded this, I think we bought a call when it was like 10 and it went to 13 the same day. I'll tell you this: if they do get approval for a reverse split, I will be shorting that reverse split. Just so you know, 90% of stocks that do a reverse split, it's usually. You remember when Dries did like 50 reverse splits? You probably don't. But DRYS was a shipping company that did like 50 reverse splits day after day, and they kept letting them do it and ended up going bankrupt. So
Yeah, I mean,
the stats,
reverse split, never a good sign to me for a I mean, just a big red flag. All right, Dave, well, I dropped that link in the chat, Wall Street Global Trading Academy. Go ahead and sign up for that webinar. We'll have to get you on again next week to catch up. But Dave, thanks again for hopping on the show today.
My pleasure. Thank you, Aaron.
Of course. Alrighty, y'all. We got to keep it ticking. We've got more guests hanging out backstage. Like I said, absolutely packed show today. Just to give you guys a quick rundown for what we're going to be doing for the rest of the show. So I've got Karl Douglas hanging out backstage. We're going to be talking Karl Douglas coming from the VC world, going to talk about this Silicon Valley Bank, everything going on there, give us a unique take there. And then after that, Lia The Trader will be talking about First Republic, some of the banking stocks, some trading psychology. Excited about that as well. And then 1 p.m., Ross Gerber from GerberKawasaki to talk some Tesla and just catch up with Ross. It's been a while since we've had him on the show. So without further ado, let's go ahead and bring on the Covenant Venture Capital Chief Investment Strategist, Karl Douglas. Let's give Karl our very special Zinger Nation welcome, especially for his first time on Benzinga Live. Karl, how's it going?
Hey, Aaron, doing great. Thanks. Great show you have there.
Oh, I appreciate it. Yeah, we've got a packed lineup today, so thanks for hopping on with us today. This is your first time on the show. Why don't you just give us a quick, brief introduction into who you are and what you do?
Okay, so I'm the Chief Investment Strategist for Covenant Venture Capital. Covenant is a venture capital company that focuses on sort of later stage venture funded companies, Series C, Series D, all private companies. We follow a cohort of about 14 of the top performing VCs. Essentially, we monitor what they invest in from seed all the way through. And essentially, once they hit a certain level of criteria, we invest our limited partners' capital in those companies. Our core thesis is artificial intelligence, which is really important in terms of, I think our AI is having a big impact on how the market's acting these days. And yeah, it's fascinating area. We've seen we crossed 100 million AUM this year, and we've invested in some phenomenal companies.
Yeah, I mean, it's timely to be talking to you. Of course, seems like the first 3 months of the year was all about AI. The last 2 weeks or last week has been about, of course, this SVB situation. So maybe when we don't have so much going on with SVB and whatnot, we can come on and just talk more about AI. But I want to get to SVB, and because I think you had an interesting take. So coming from the VC world, what was it like kind of behind the scenes when all this was going down? Was there a lot of fear? Were a lot of companies worried they wouldn't have access to funds for a long time until settlement and bankruptcy, all this stuff went through, or was there a lot of people that thought, okay, maybe the government will step in and we'll be able to get some of our funds quicker?
Well, this crisis came out of nowhere, right? I mean, I know some people in the credit markets were following it as far as 2 weeks ago, but it really manifested, from Tuesday last week and really hit its stride on Thursday when there was a massive amount of wires going out. I think it was like 45 billion or something, was wired out. Silicon Valley Bank, first of all, I would say that the Biden administration really reacted brilliantly in terms of the speed that they stepped in to save this, because a lot of people aren't aware Silicon Valley is the 16th largest bank in the country and plays such a critical role in the venture space, right? They kind of sit between founders and the larger VCs and intermediate a lot of the the activity there. One of the bigger venture lenders as well. We're Covenant's a venture lender as well, but Silicon Valley is a massive venture lender providing capital to early stage companies. Many of those companies are in artificial intelligence, and we're at a point where in Silicon Valley there's so much new technology coming out. There's like a wave of new technology that's going to really change and impact the economy, and to have lack of liquidity hit at this critical juncture, it would have been a disaster. So kudos to the administration for stepping in and doing such a brilliant job.
Yeah. So what I guess was the big I guess fear. What would be essentially the big problem? Because at the end of the day, it's not, a lot of the companies implicated. It's not, your Apples, Googles, companies that employ thousands and thousands of people. Had the Biden administration just sat back and let some of these tech startups, VC funded companies basically get screwed because of SVB's collapse, what would be the bigger economic implications of that?
Well, essentially, it missed the next generation of software. It would essentially slow down the rollout of that. The Apples and the Googles and many of these larger companies that we all see in the public markets depend on that next layer down of private companies that, some of the private companies actually end up going into the public markets, but many of them develop software and essentially get either bought out or the software gets licensed to allow those companies to create their next level of a new product. So, lack of liquidity to those smaller companies basically stifles that development effort. And we are, from an AI perspective, ChatGPT, as you mentioned, has really become a huge phenomenon. It's just beginning to take root. All of the companies that would be using that open source software to deliver new types of intelligent technology, let's say in marketing platforms, in CRM platforms, would basically have lack of capital. It'd be layoffs. We'd essentially not be able to keep up with the demand.
Got it. So Karl, I'm curious, specifically, I know you gave us some comments about the actual, bond trade or issues that SVB ran into and kind of how those materialized.
Yeah, so the general story on it, at least my sources have indicated that the issue was an unhedged portfolio. SVB actually did what would be the right thing in terms of investing their assets in relatively safe securities. They were in treasuries, high grade mortgages. The problem is that the portfolio was unhedged. It was a fixed interest rate portfolio. And normally what you would do in portfolio management is use a swap transaction to swap out fixed rate for floating rate exposure when you're in a rising or volatile interest rate environment. And, with the Treasury raising rates consistently, I guess there were 7 rate raises last year. You're obviously in a moving environment. You don't want to be in a fixed rate portfolio. Rates go up, bond prices come down. So essentially their asset value declined to the point where they became insolvent. The reality is that, it was about a $20 billion hole. And, it was a small price to pay to avoid, the potential systemic risk, which they use the systemic risk exception to, secure all depositors. A small price to pay for what would have happened if this bank actually was, left to, or the depositors were left exposed, let's say.
Got it. That makes sense. So, why do you think, essentially the bank was not, hedging against these positions, right? Because as you described, the interest rates rise, the bond prices fall. They were buying these bonds at a time where interest rates were at or near zero. And what could have they done differently? Do you have any explanation for why they weren't hedging that position?
I thought about it a little bit, and I think that they may have felt that we were getting to the top of the market in terms of the rates, and maybe they didn't want to hedge for that reason. There's also a cost to hedges, which might have been an issue. But at the end of the day, I don't have an answer. That's that's one that's going to have to come out when they do the analysis. But I think that, one of the things we need to do, like this is the second go around, right? Last big failure was WAMU in 2008, which was part of the financial crisis. And coming out of the financial crisis, we had Dodd-Frank regulations that basically put layers of stress testing in for banks. But those are done, quarterly. I think where we are now is, given the level of technology that's available to us, particularly in terms of artificial intelligence, I think that, where banks need to go and where the regulators need to go is in terms of full on real-time, systemic risk analysis, using AI software, man. I mean, AI is trading the market more effectively than most people out there, right? So, it can certainly be used to isolate risk way ahead so that we don't have these issues.
Yeah, and I think that makes a lot of sense. And I think a lot of times when you see these types of failures, whether it's by a bank, company, whatever, it's like you said, like maybe they think, okay, the interest rates are about to top out. We don't need to hedge against this position. They really, it's not out of any sort of uninsured negligence, maybe, but not, like not nefarious intention, like they really think they're going to be okay. They're not trying to screw over their depositors. They're not trying to screw over their customers. And I saw a lot of people on Twitter saying, oh my God, these companies that were banking with SVB were so stupid for having so much uninsured money there. And it's like you said, they were the 16th biggest bank in the country that had a long track record through the dot-com bubble crisis, through 07, 08. So to act like these companies it was stupid or negligent to be banking, like that was, to me, just a crazy takes that I saw on Twitter. But again, I talked about this earlier on the show. I think just a problem of people trying to talk about things they don't really know a lot about.
Yeah, definitely. And it was, look, being in the industry and really, having accounts at Silicon Valley and, being in the middle of it, I think everyone was really caught. Like you said, 16th largest bank in the country. Economy's not, imploding, like we had in the financial crisis. No one expected this. I think that, where we are, we need to just revisit. There's a good lesson learned here. There are alternatives to FDIC, deposits. I think a lot of people are going to be moving large amounts, and you had tons of VCs with like billions of dollars there. I think a lot of those assets are going to go into, treasury-based ETFs or things like that, limit the exposure that you would normally have with a bank. One of the things, going through it that was really surprising to me is that once you get past FDIC level of 250,000 per business, per account per business, you're second in line to the secured creditors of the bank. So when you're basically going to put money into a bank, you need to understand what the secured credit obligations of that bank are, because your excess uninsured deposits are behind that. So if you have a bank with a big liability side of the balance sheet, secured, you're behind all of that debt. So my advice to a lot of, not giving advice, but what I'm going to be doing is definitely looking at, leveraging ETFs, with, treasury-based ETFs for excess deposits. And most of the banks are offering that,
Got it. That makes a lot of sense. I think you've given a lot of really good color on this situation, especially coming from the VC perspective. Before I let you go, Karl, because we're running out of time, how do you see the overall VC, what's going on in the overall VC space right now? I mean, is it as simple as everyone's just waiting for interest rates to come down a little bit, or are now people a little bit more willing to take on some investments or speculation as maybe some uncertainty has subsided with inflation, things like that? Where does everything stand just in the overall VC space right now?
Yeah. Well, before the big interest rate run up, I mean, a lot of the VC capital was going into later stage, ourselves as well. We're basically going into, sort of Series C, Series D, Series E, pre-IPO type securities, because the returns were just phenomenal there. Now the environment's changed. There's a ton of capital sitting on the sidelines waiting to be invested. It's coming out at a trickle, mainly because a lot of the strategies have now shifted to the earlier stage companies, less so to the later stage. Part of that's a result of the IPO window being closed. And part of that's a result of, there's a new wave of technology out there, right? There's a term coming around called legacy technology, right? Some of the companies that their technology is 4 or 5 years old, believe it or not, is now becoming legacy technology. And there's a whole new generation of software that's coming out, all AI based. So there's a shift toward earlier. I think that spigot is opening up for the earlier stage companies. Some of the larger VCs, more well-known VCs that we actually follow, have really started to accelerate in terms of the early stage. Still small dollars. I think we're looking for interest rate stability before we really jump in. Valuations have obviously been compressed over the last 18 months pretty significantly. We were seeing like SaaS software multiples on private transactions ranging from 20 to 30 times. Now it's sort of 10 to 12 times. If you're in a lean market, maybe a PE company will pay as much as 15x for SaaS multiple. So you're looking at, still there's a lot of compression in terms of pricing, but I think once we see interest rates, inflation kind of level out toward the end of the year, assuming that's when it happens, you'll start to see a lot of that money come off the sidelines for venture capital.
Yeah, I mean, I don't think it's specific to venture capital. I think there's a lot of money on the sidelines in general right now that are kind of just hanging out, waiting for these interest rates to come down. And it's really a big question. I mean, a lot of people thought that with everything going on with SVB, that might cause the Fed to either stop rate hikes. I even saw some people, I think Nomura said they were expecting a cut. Looking at the bond markets and stuff, it looks like the expectation right now is for another 25 basis point hike coming up. But it feels like we're getting closer to being, as every single rate hike we get, right? We're getting closer to eventually cutting rates. So depending on how you look at it, I think people are, again, a lot of cash on the sideline waiting for that to happen. Whether you're talking public equity markets, whether you're talking VC. Karl, anything that like I said, I want to bring you back on and we can just talk basically all AI, talk different things, but anything regarding SVB or overall VC that we haven't gotten to yet, because we've only got about a minute left.
I think, look, again, the crisis has been averted. Brilliant action on behalf of the Biden administration, just with the speed. I was not certain that was going to happen over the weekend. We thought that it might just be, FDIC deposits covered, et cetera, but brilliant response on their part. I think they've really avoided a crisis. And as you can see from the markets, it's all green today. So, we're happy about that.
Awesome. Well, Karl, thank you again for hopping on Benzinga Live with us. Again, we'll reach out to get you back on in the future, but hope you enjoy the rest of your day and we'll talk soon.
Thanks, Aaron. I appreciate it.
Yep, no problem. All right, guys, that was Karl Douglas, Chief Investment Strategist at Covenant VC, giving us the VC take. We've gotten the takes now from basically, we had Tim Melvin with the regional bank tank. We had David Green talking about from the stock perspective. We're going to be talking a little bit more about some different regional banks here in a second. First Republic, a stock that I got in yesterday. I know I'm not the only one. So without further ado, let's go ahead and give Lia the Trader, our very special Zinger Nation welcome, also making a first-time appearance on Benzinga Live. Lia, how is it going? How are you doing today? Welcome to Benzinga Live for the first time ever.
Hi, Aaron. Actually, second time.
Second time. Well, I don't think with me. I think you've been on with
someone else. Yeah, but
with someone else. Okay, I was gonna say I would have remembered having you on. So it's not. Yeah. I know you've been on Benzinga before, but with me for the first time. So this is when it really counts.
Okay, good. Yes, nice to meet you. Thanks for having me. I'm excited to be here.
Nice to meet you as well. So we were chatting on Twitter and we both got into FRC yesterday. We both bought some FRC stock. Let me go ahead and pull up my my Benzinga Pro because basically, I mean, I thought some of the fears were a little bit overblown. I didn't really have any technical reasons or any you know, like fully thought out investment thesis. I was just like, hey, it seems like people are freaking out, and I don't really necessarily agree with them. So I'm going to go ahead and buy some stock. Can you walk me through your process on why you were buying FRC yesterday?
The same thing, you know, like Silicon Valley Bank, sure that they had a huge blow up and I would not buy that stock. And I had a lot of people asking me, should I buy SI right now? Should I buy Silicon Valley Bank last week on Friday? I said no, because it's super speculative. But First Republic Bank, I had a hunch that they are not going to let this bank to go down. And I mean, when it tanked so much yesterday, it just was kind of a common sense to buy some shares. So I went full in with 1,000 shares and I sold puts. And as we spoke about, it was very illiquid. It took me about 10 minutes to actually sell the put. It took a while. It wouldn't fill. But then at some point it filled the put, and then the stock just started rolling up the hill. So I got filled in. I posted it on my Twitter. What was my fill? It was about 29 something, or closer to $30. And I just held it, and I could have sold yesterday by 40, but I said, you know what? I think it's going to have more juice tomorrow. And I actually was selling partial in pre-market. And then my highest one I sold was $49 something. So I'm out of that trade. And that's where the psychology comes in, because, you know, sure, the stock might go higher. We can see First Republic at some point at $80. It's possible. But for me, making over 60% on an equity trade, that's amazing. Like, I take it and I'm happy and I'm not going to look back. I closed my puts. I made over 80% on those puts. And that's also amazing for me. That's a good trade. Like, I am not complaining. So
yeah,
or what did you do?
I initially yesterday. So first of all, last Friday, I bought some Western Alliance stock, and I thought it was a brilliant trade because it was down like 40% on the day when I bought it, and it ended up closing down only 20%. So I was up 20%, and I was like, oh, this is awesome. I'm such a smart trader. And then on Monday, the stock opened down like 50% or whatever. So I was down a bunch of money on it. But then I was like, you know, looking at the situation more, and I was like, yeah, I'll buy some FRC, kind of almost like dollar cost averaging into some of these regional banks. And like I told you, I wanted to buy call options because, especially in a very volatile thing like this, I was thinking, okay, there's a chance this is trading, you know, back above $50 by next week. Looking at calls, the market for the options, like, it just seemed a little illiquid, and then also with the increased volatility, really expensive to be buying the options. So I just bought straight up equity, common stock, which is, you know, usually for quick trades, not what I do. I'm usually only buying like common stock for investments. I usually, if I'm trading, I usually do more options or different types of derivatives. But like you said, a 40% gain on just a common stock trade overnight, like, that's nothing to sneeze at. I'll take that all day long, and you don't get those opportunities in the market very often. So I did sell my First Republic stock today just because it was such a quick and decent gain for me. But that doesn't mean I think really the stock is going back down. In fact, like, I could probably be talked into still buying some here for a few months out, saying like there's a chance this, you know, comes back up to, because especially with the bank stocks, and if you look at the fundamentals, it's pretty easy almost to assign like a book value and to say, okay, this is trading below book value from a fundamental standpoint. Other stocks, it's harder to look at it at that perspective. But for some of these bank stocks, it becomes a little bit more straightforward. So the fact of the matter is, these things are still dirt cheap. It's just a question, do you think there's still going to be more fear out there? Do you think there's going to be, you know, more banks failing and these things happening? And really, I still don't really think so. Again, this isn't investment advice or anything, but I wouldn't want to get short this essentially here at $46.
No. And I sold puts yesterday on JP Morgan. I sold puts when we had the morning dip for the very first hour before we had the reversal. I sold puts on FRC, on Schwab, because Schwab also was thinking, my God, Schwab is so safe. I mean, when you compare it to Silicon Valley Bank, they're truly making sure that their people are safe. Whoever has money with them is fine. So that was just an overreaction. So I bought not only common of Schwab, but I sold puts. I closed the puts today because, again, I was up over 60%. And in one day, having puts that are month out being up 60%, that's for me a rule when I'm closing these puts. I'm buying them back. So it's amazing income for me. If of course if they're like shorter, then of course it's moving much faster. But it was like 2-3 weeks out. I mean, it's right here. Schwab was March 24th that I sold, and FRC I sold for April 21, like over a month far out. And again, like 80% on those puts, I bought them back. It was an excellent trade, and I'm still in Schwab shares, which I might actually keep for longer, to be honest with you. Because I believe Schwab, I feel safer with owning Schwab than FRC, because FRC, no matter what the news are going to be, it will be super volatile. But as a trader, you can use it to your advantage.
Yeah. I mean, with Schwab and some of these bigger banks, I think too, you had, a lot of selling pressure and fear. I mean, Bank of America hit 52-week lows yesterday and all these things. And it's just like, all right, I can almost understand some of the regional banks being down this much, but like, come on now, Bank of America, Schwab, JP Morgan, like these things are going to be fine. And again, I've talked about it a lot on the show today, talked about it on Friday. The problems at SVB, the withdrawal pressures that Silicon Valley Bank was facing, was specific to the high growth tech space. And like you look at some of the other companies that might be banking with, your local like mom and pop restaurant that's making a certain amount of profit every week. They don't have the same amount of withdrawal pressure. They don't have to go, to the banks when interest rates rise, because essentially what happened is these companies, the funding, VC funding slowed up. So they had to go into the reserves and all these things. That's specific to what SVB was doing, not like the overall banking system, and this whole thing's going to crash. So a bunch of people, I think for whatever reason, maybe they're just super bearish. Maybe they're the doom and gloom type of perma bears. For whatever reason, a lot of people wanted to make this out to be the next 2008, right? That's what a lot of people. Yeah. So Lia, because we've only got a couple minutes left, and this is a good opportunity to talk about some trading psychology. Walk me through, your basic kind of trading psychology, what you're thinking about, and how you kind of like are able to take some emotions and fear out of this. Because if you were getting swept up in all of the other emotions and fear on Twitter and all this stuff, you probably would have been too scared to buy FRC yesterday, and you wouldn't have made your 80% gain overnight.
Yeah, people called me crazy on Twitter, but it's okay. I don't listen to people. I listen to myself, to my knowledge. I have a plan. I know when I want to get in and out. That's the number one thing. You know when you want to get in, when you want to get out, and if the sentiment changes. And that was my plan, and I stick to my plan. I do not follow the noise. And that's super important in investing, in trading. You have your plan. You know when to get an in and out, and you follow the plan. And then again, I have the rules of the percentage. If I'm up on equity certain amount or on this, I sell a lot of puts, then I buy them back. And I'm happy, and you don't have any more FOMO, because a lot of people, they sell stock with profits, then the stock keeps going higher, and they FOMO into the same stock again to try to grab even more, which is greedy action. So I don't do those. So greed and fear are not on my list. And that's number one, what you have to eliminate when you trade. And if you have a plan, then you will see you're not as reactive to the emotions, because you know what you're doing. And then just don't listen to Twitter. that's my big
Don't listen
advice.
to Twitter. Yeah.
Get there fishing of ideas, but make them your own. Make the trades your own. Don't just blindly hop on trades of other people, because that's when the anxiety kicks in, and that's when you don't know what to do and you're losing money.
Yeah, and so I think that's so what would be your like number one tip for someone that's just getting started in trading, and maybe they're struggling a little bit with the psychology aspect of it?
Just trade with very little amounts, and don't look at the P&L. Don't look at how much I could make, should have, could have, would have. Just trade with little money. I don't like paper trading. I like to rather trade with real money, but small amounts, even if it's $20 risk reward, and always have your risk amount, what you are ready to lose on each trade, and set that up and say, I want to lose $20 or $50 when you're starting, just to test it out, and set your stop losses.
Yeah, I mean, for me specifically with options, and I've talked a lot about this on the show before, when I buy just outright call or put options, and typically they're out of the money and I'm going for, big risk, big reward, I don't do it with money that I'm not comfortable losing in the first place. And when I have that mindset, if it works against me and goes down, guess what? I don't let it ruin my day, because I treat it like it was essentially a sports bet, right? If I bet $100 on a basketball game, or I bet $100 that S&P 500 is going to go up 1.5% before tomorrow, each one, I don't really know what's going to happen, but I'm willing to take that risk on. So I treat them about the same. And then when you have that mindset, it makes it a lot easier to handle losses. And then, you don't get burnt out in terms of being like, oh, I lost some money, I'm never going to trade anymore.
Yeah, it traumatizes people. And I used to day trade options last year and year before, and I realized it's not for me. I trade equities more and I'm selling options. But with the options, it's easy to manage your risk because you can have absolute zero risk. You can buy option that is cheaper. Like, for example, Tesla was hard to trade if you have like risk reward, or your risk unit is $200 or $50 because Tesla options are very expensive. But if you trade other stocks, you can say, okay, I buy one contract and it's my risk, basically, this contract, if it goes against me. Sure, it's good to get out fast, but if you're trading short-term options, they're moving just way too fast. It's really hard to set stop losses there. But as you said, like, that's the mindset. This is what you want to lose, and if it goes against it, you're fine. But if people the problem, what people do, they start sizing up, they start averaging into losing trades, and then they just are oversized, and their losses are massive. And then they don't manage to make this money back fast, and that's when the whole trauma happens, and people get scared and don't trust the markets anymore.
100%. Well, Lia the Trader, thank you for hopping on with us today. We got to get you on again. I'm going to go ahead and drop your Twitter in the chat so people know where to follow you. Stock and options trader and a trading psychology coach. Lia, thanks again for hopping on Benzinga Live.
Thank you, Aaron. Have a great day.
You do the same. All right, guys, that was Lia the Trader. Again, going to drop her Twitter in the chat. Go ahead and give her a follow. We're about 5 minutes behind, but I've got my man Ross Gerber hanging out backstage. We're going to be talking some Tesla as well as some other stocks. So without further ado, let's go ahead and give Ross our special Zinger Nation welcome. And we'll have Mr. Gerber when we come back. Ross, how are you doing today? Welcome back to Benzinga Live.
Thanks for having me. I'm pretty good. How about you guys?
Pretty good as well. It's been a while since we've had you on the show. What's been going on since then? Any big developments at GerberKawasaki? I know there's been some, maybe a board run at Tesla, and then
right. Yeah. Lots of Tesla stuff and drama related to that, and once again, we are having actually a pretty good year investing so far. So, we like certain areas of the market a lot, and hopefully we can be done with the Fed. But things are good. We're super busy, and as always, and we kind of like when there's turmoil out there. It creates opportunities, and we were able to take advantage of a little bit of it.
Yeah, I mean the old Warren Buffett line of be, greedy when others are fearful, and fearful when others are greedy. So the market turmoil.
Yeah, and a lot of the positions that were hit have nothing to do with Silicon Valley Bank, and really have no issues. So it was really a unique situation, which is now righting itself quickly in the markets.
So let's start there, I guess, just because that's been the big news of the week. I mean, what is your kind of big takeaway now that a lot of fears have subsided? Of course, you had the Biden administration stepped in and helped make sure all depositors are full. I mean, do you think it's just that's behind us, everything's passed? Are you still worried about some parts of the banking system right now?
No, I wasn't really worried about the banking system before this event, and I'm not really worried about the banking system now because it's just run so differently than it was pre-financial crisis. And, I'm old enough to have gone through the financial crisis as an investor, and I was affiliated with a firm that went under AIG at the time. And so I went through this horrendous disaster of a event firsthand. And when we started GK, that was like the whole idea was like, how do we insulate ourselves from being affiliated with any of these banks and insurance companies that, oftentimes do things that you have no idea that they're doing. So that's why we're a completely independent company. But when you look at Silicon Valley Bank, they manage their bank assert very aggressively and in a very concentrated group of clients. And when those clients started having financial issues and needed their money, which is not unusual, the bank wasn't prepared and liquid enough to address the needs of its customers, and they went under. That's that. But the other banks are fine.
Yeah, I mean, and I think you have a good perspective on it because, like you said, you were in the business during 07, 08, and could understand the difference of this situation, what was going on there. I think a lot of people on Twitter and whatnot did not see that difference and wanted to make this out to be last Friday over the weekend. Oh my God, the sky's falling, 07, 08. And, honestly, like, I love it because that's always a good sign for me to say, like, okay, I'm going to start buying right here.
Yeah, well, there's a certain group of hysterical Silicon Valley investors that, were directly impacted. And of course, immediately these conservative minded folks were asking for a government handout as soon as possible. So I found that entertaining. And then secondly, obviously it doesn't make a lot of sense to put a lot of small businesses out of business because a bank is poorly run. And the Fed did the right thing by taking over the bank and having an orderly wind down of this institution versus sort of the mayhem that it was going to cause in the startup, economy that really sort of didn't need to happen. So, I was pretty happy with the outcome because this is really what the banking regulators are here to do. And certainly the regulations that were changed around banks like Silicon Valley Bank now need to be looked at and say, these banks are systemically important, even though at the time it wasn't, right? And so we have to really continue to highly regulate banks, and that prevents these things from happening. But the financial crisis, all the debts the banks had were bad debts. And so it was like a completely different problem,
Yeah, 100%. And I mean, that's what a lot, the sound-minded people were pointing to the fact that, look, I mean, at the end of the day, a lot of the assets that SVB was holding, like, they're not worthless, right? You can go through, I mean, it's like, but yeah, I mean, I agree with you 100%, and not to get too political, maybe you don't want to name names or whatever. I don't care. I will. It was kind of funny to see David Sachs or whoever who are all like, oh my God, the big bad, they're always big bad government, no regulation, free market capitalism. And then as soon as this, oh my God, where's the government? They need to step in and help us. And so if anyone out there, doesn't matter where you stand on the political aisle, can't see the irony in that, then I don't know. Cause it's.
Yeah, you're 100%. And also, the yelling fire in the crowded theater these guys are doing, like they live in their little bubble and their little bubble has this issue and they start yelling fire, like the whole system's going to collapse, and really created an unnecessary level of fear, to be honest. And then sort of taking credit for the government's moves, like they had something to do with it, like the Fed and Yellen is sitting there on Twitter listening to Jason Kalkientis and David Sachs. So, but that's Twitter, and Twitter isn't real life. And a lot of people who are heavily involved with Twitter think that it's real life, but it is not. And I think that there's a misperception. If you spend too much time on Twitter, you're not actually understanding what's happening in the real world very well. And so the panic was very much unnecessary. And I think the Feds did the right thing. And, once again, I just don't see this as that big of a deal, other than the best part being that the Fed finally broke something, and maybe we'll stop jacking up rates so high so that everybody can digest where the rates are and run their businesses correctly. And the last thing we need are bank failures and startup failures and our economy going into a deep recession. And I think this is finally a real world consequence to the Fed's academia exercise in trying to beat inflation like he's Paul Volcker. So this is great news for stocks. We're seeing a rally today, but after a decent inflation number, in my mind, the Fed needs to stop raising rates. I've been saying it for months. Now they finally broke something and everybody's like, oh, they're going to stop raising rates. So it's like, I've been saying this. Why does something have to break before anybody cares? Well, now it's broken, and now there's risk, and now the Fed realizes there's a consequence, and that's very bullish because we can get the Fed out of the markets, we can actually make some money in stocks again.
Yeah, and 100%. And I think, a lot of money is on the sideline waiting for that to happen. And honestly, like, I know it's not that simple, but like, why not? Why don't just stop the rate hikes for a little bit. If inflation starts picking back up, okay, we'll do 25 again. Like there's all this talk about like the inflation's a lagging indicator. You're not going to know whatever. And I think you saw Canada that they stopped hikes and said, okay, because we understand a lot of this data coming in is lagging, and so we're just gonna chill out and see. We're not gonna say we need to keep raising rates because, again, like you said, inflation's been moderating. But yeah, I mean, to your point, I honestly think that that group of guys, Sachs of them, I think they think 100% of people on Wall Street and finance do listen to them on Twitter, listen to their podcasts and stuff. When that's not the case, right? Like, there's probably a lot of institutional money, people that are doing their own things that don't care what they have to say at all, and it doesn't hold any weight. But they probably think, oh yeah, Yellen is listening to the All In podcast and doing all this stuff. Yeah. And so I don't know. It's funny, and it's
Silicon Valley never seems to get enough of themselves, and that's fine. And I think they also got a lot of populist backlash for what they were saying too. But I generally like those guys. It's not like I have anything against them, but I think once again, those people live in a bubble, and in their bubble world, everything around them matters, and all these startups with no revenue is like our whole economy or something, and it's just not. Amazon, has so many employees and so much effect on our economy. You can't even compare it to anything that was at Silicon Valley Bank. So it is what it is. But just the same, I think there's this accountability issue that is constantly skirted, and the shareholders of Silicon Valley Bank and the employees have certainly taken it on the chin. So I think the Fed acted correctly by not per se bailing out the shareholders of the bank and the debt holders of the bank, which in a lot of it is actually in index funds. So Vanguard was actually the biggest loser out of all this. I mean, they lost so much money for clients because they're just an index fund. But when you really look at it, I think this is one of the problems with index funds is that you don't actually have board representation for a big chunk of the stock. And then there isn't this oversight, which is sort of the whole thing I was doing with Tesla, is that boards in America are broken, and the index funds are a big reason for this.
Interesting. I would love to get more into that, but that sounds like it could be a whole 20-minute discussion on itself, is the impact of having these funds that hold all these shares, and become essentially like the majority holders of these companies, and it takes away from the board. And again,
Vanguard owned 11% of Silicon Valley Bank, and Vanguard owns 11% of First Republic Bank. You know what I mean? This is a substantial position, which would have a board seat normally,
Interesting. Yeah. And I wonder what the potential solution for that could be down the road. But let's, I don't want to have you on and at least not touch on Tesla. So you've been a big Tesla bull for a long time. Is it correct that you've begun selling some shares? Did you sell the entire Tesla position?
No.
What's going on there?
No, that, once again, I think that's Twitter again,
Twitter, right.
Always making something big. No, we managed to an allocation. Our allocation to Tesla is between 8 and 8.5%. We've been keeping it at 8.5%. I bought Tesla when it went down. It rallied back up, so it became an over 10% position in the fund. So, I trimmed it down to what it should be. And, so we made money on that trade on Tesla from 100 to 200. Tesla is one of the most innovative and impactful companies of our time that now has a CEO who goes out every week and destroys his reputation. And so, we're very bullish on Tesla and very bearish on Elon, and unfortunately, this is affecting people's perception of Tesla's products and services. And so I think that's the biggest risk now is just Elon, but the company itself is performing quite well, and we're very bullish on the year, and they have some major things they need to accomplish this year with full self-driving and 4680 ramping production, as well as getting the Cybertruck launched, and they're all kind of intertwined. So it's a crucial transitionary year for Tesla. But if they're successful with these things this year, moving into 24 looks amazing for them. So we're bullish on Tesla. It's really just about the volatility that's caused because the CEO works at Twitter.
Yeah, and I actually I'm in so much agreement with you here, Ross. I've been on the record on this show. I've said I'd be way more bullish Tesla if Elon is gone. And I I'm glad that as a big Tesla bull, as someone who holds 8% in your fund, 8.5%, you're not so blinded by it that you can't recognize some of these problems. And I mean, again, I don't want this is a show about stocks, show about investing. So we're talking about trade ideas and whatnot.
This is a stock, right?
Not to get no, I'm saying I was gonna say what I'm gonna say, not to get too political, but like you gotta understand like your business is selling electric vehicles. Most people buying electric vehicles tend to lean to the left in California, New York, wherever. And if you're pissing all of them off at a time where more and more competition is hitting the streets, it's not a good recipe. And so I've, been maybe less bullish Tesla than you recently because of this, because I think eventually you're going to see these things, trickle down into car sales, into revenue.
Absolutely.
And it's hard to imagine not. But like you said, I mean, they're still one of the most innovative companies. They have technology that other companies don't. But to me, like it irks me so much, these, either Tesla bulls or just Elon Musk fanboys that can't even like see this problem. They're just blinded to it, that they can't see the problem that's that Elon is creating for literally no good reason. Like, what is he doing it for? For likes on tweets?
I honestly, what you're saying, I'm 100%. Like, our clients hate him now. Like people want to sell their stock, because of him. And we did a survey of Tesla owners, and we were like, the only reason Tesla continues to just dominate is because there aren't other electric vehicles, and these people are willing to sort of like not think about. But he's becoming like the Henry Ford of our time, unfortunately. And, this is not a good thing, and I'm not sure why he's becoming the Henry Ford of our time, but he is. And so like people will buy other electric vehicles if they have a choice. And right now they don't, but they will. And they will have many choices in the next couple of years. And this will affect Tesla. Now, on the same respect, the company is a great company, and the more they can do to further themselves from the opinions of their CEO, the better. But, when you're attacking disabled people and then supporting treasonous, basically Nazis, you're really not doing a great job selling electric vehicles. So I don't want to get into the politics of whether you agree or disagree with Elon. That's fine. But when you're talking about selling electric vehicles to basically left-leaning people, this is not a good strategy, and it will affect them over time, despite what a lot of people are saying. So, I love to see him give up Twitter and just be CEO of Tesla. But this is not going to happen. And I think people have to accept this, that he's going to be running Twitter indefinitely, and Tesla is going to be Tesla. And there's a valuation shift that we've seen in Tesla because of this. So we can wonder why the stock's at 180, 200. Well, there's a valuation shift that's happened because of Elon, and that's a reality. So, we still value the stock around $200 a share, but we think for the stock to move higher, they have to have earnings go up, and that means they need to get their margins back.
Right. And I think, you made a good point, though, where it's separating whether you agree or not with Elon. It's about, as the CEO of a company that sells cars, is this good or not? And it's something that, even Michael Jordan intuitively understood in the 90s. He famously said, people were upset he wasn't getting involved in certain political things. And he said, hey, Republicans buy sneakers too. Jordan knew that as a businessman, as the head of Jordan or the spokesperson, his job wasn't to get involved in politics. It was to sell sneakers. And I think Elon needs to take that sort of mindset and say, it's not my job to get into politics. It's my job to sell cars. And to your point, if Tesla had a board or a functioning board or a competent board, they'd be telling him that too and forcing, to do it. So it's a crazy situation. I don't, we'll see how it unfolds. But
the Tesla board works for Elon, so I don't think anybody should be confused. They do not represent like individual shareholders that own 87% of the company. They represent Elon, all of them, and they're going to do what's best for Elon. And that was sort of one of the reasons I pulled out of the board, was I realized like there was very little I was going to accomplish being on the board other than fighting constantly with everybody. And so, that's what Tesla is. And I think investors have to weigh this, that Tesla's going to do what's best for Elon. And that might include more stock sales in the future, because he's going to have to fund Twitter or whatever his other ventures are at some point. And his only liquidity is Tesla, unfortunately.
Yeah, and I mean, I'm sure you've thought about that, but I mean, he if you were on the board fighting him and whatnot, I'm sure he would have been using his big following to attack you and make sure
Yeah,
that
it
all
would have
his
been a
people
nightmare.
hit. It
Yeah,
would have been a nightmare. So,
yeah.
all right, I'm seeing, FRC just got halted again to the downside.
Oh,
I
did
don't
it?
know. Yeah, I don't know exactly what's going on, if there's a specific headline, but I think some of these regional banking stocks, let's check Western Alliance, might also be No, Western Alliance is trading, but FRC is halted again to the downside. Again, I don't know. I've been live on the show, so I don't know if there's like a specific headline or what's
Yeah,
causing this.
I'm not gonna comment on the banking stocks because we're trading in them, and anytime I talk about a stock now, we can't trade in them. So I don't want to comment about specific banking stocks, other than I think there's a ton of opportunity in the regional banks.
Got it. Yeah, I mean, I don't disagree, because we talked about on the top. I think a lot of the problems that SVB were facing were specific to the that
Totally.
startup high growth space, and that some of the other banks that work with other types of companies shouldn't be facing those same types of problems. The problems will arise and can arise if, again, just the simple fear of that causes more of these companies to want to pull money out of their regional banks.
We talk to a lot of high net worth clients, and many who do banking with some of these regional banks that we're talking about. And there was definitely a fear of people who have like large balances. But then I was like, well, where are you going to move your money? Basically, it's either JP Morgan or nothing, kind of thing. And it's like, well, basically JP Morgan's become like the Bank of America, right? And but I think most customers, after they take a few deep breaths and the Fed's action, they're probably not going to end up moving balances all over the place and all this, because they have all these lending relationships with the banks. So when you move money from a bank, it affects your lending with all these banks. And most of the high net worth clients at these regional banks use all these lending products. So we just don't foresee some radical shift in the nature of banking just because it's Silicon Valley Bank. I think over the course of the next week or two, things will calm itself down, and life will go on.
Yeah. Well, Ross, thanks again for hopping on with us today. It's been a great conversation. Again, I would love to have you on again to talk more about just the overall problem that you see in terms of the funds holding so much shares of companies that it takes away from the power of the boards. Because I think that's a real problem that doesn't get enough shine. People don't talk about it enough. And I think you, as someone who, runs a fund, has your own ETF and stuff, has some good insights on that we can talk about, and maybe make more of a long form 30-minute discussion just on that, and put it out as a podcast on Spotify and stuff. I think
that's
cool.
a great idea and a great discussion, because that was one of the things I realized right when I started running with the board. It was like, well, who do I have to get to vote for me? Oh, well, there's 3 companies that own more Tesla than Elon, and I was like State Street, BlackRock, and Vanguard, and I was like, well, if I can get these index funds to vote for me, boy, it's game over, but they just don't vote for people.
They don't do any. So Vanguard doesn't even have representatives on boards at different companies?
No, they just vote for management 100% of the time. And so they're required to have some sort of proxy ruling, but because they're a passive fund, they don't take positions.
They don't take activists. Right.
Right.
I wonder, what I've always wondered about would be essentially somehow pooling every single retail, if all retail shareholders of Tesla had a board rep, you know what I'm saying? But then I guess
that was
not
the
all.
idea. That was my idea. It was I would be the retail board representative, and then half of retail is like, oh, we don't like this idea now because of this.
We're going to side with Elon on everything anyway.
Right. And I was like, well, I thought I was going to represent you. Now you guys are picking at me for everything, and it's I represent retail shareholders. That's whose money I manage. I do not manage institutional money. I manage money for thousands of families, and we represent retail. But once again, the politics around Elon have gotten somewhat toxic, and I, it's the same thing with my company. I don't get any points for talking about politics, and I can tell you that I hate DeSantis, or I love Biden, or this or that, and you're just going to get attack left and right, even in any opinion you have. And it doesn't necessarily serve my client base either, because politics has gotten so toxic. And I'd love to see America move back to a place where we can all have conversations and maybe not agree, but have them within some realm of reality. You know what I mean? But that's just not the way it is anymore. So when you make any statement about politics, even abortion. You know, they're banning abortion all around this country, which is a crime in my mind that they're doing this to women. But if you get into these issues, you still get attacked that I thought were just like, you know, guarantees, you know, like who's against this still? Well, I guess we're still fighting the Civil War, you know?
Right. It's like
some of these people want the Civil War, you know?
All of a sudden you're crazy for saying like, wait, we're moving back in time 50 years, a decision, you know what I'm saying? And it's like, I am 100% in agreement with you because it is important, I think, to understand some of these things politically, even from an investing perspective, because take a look at like the Elon Musk Tesla situation. You have to realize, like you said, there's a whole different valuation, and it's not part of it maybe is because he bought Twitter and it didn't look like a good investment, but part of that is literally because of the politics he's putting on Twitter, and you have to be able to understand that from an investing perspective. So again, Ross, thanks for hopping on today. I'm gonna reach out and we'll get something scheduled when we have some time to do that kind of more long form discussion on the board and the funds. But yeah, enjoy the rest of your Tuesday. Thanks again for hopping on.
Yeah, thanks for having me. I always enjoy the show, so I appreciate it.
Of course. All right, guys. Ross Gerber from GerberKawasaki, Fund GQ, if you guys want to go check that out. But it is 1:30, which means it's time for us to wrap up the show for the day. Hope you guys enjoyed the show. We had a very packed show from, Karl Douglas coming from the VC world, David Green, live trading, Ross Gerber, Lia the Trader, Ben and Dillon from PeakBot. So all around packed show. Bunch of guests. We're gonna get a lot of those guest segments clipped up, and so if you want to go back and watch just the Ross Gerber segment or watch just this and that, you're more than welcome to go do so. So, but guys, thanks again for hanging out. Please smash the like if you have not already. Please give us a follow on Twitter, TikTok, Instagram, and we'll be back on Thursday with more Benzinga Live. Till then, stay green. Again, I still don't. Before I go, I guess let me check back in on these regional banks, see if they're trading again. Yeah, it looks like First Republic Bank is trading again. Let's go to a 1 minute chart so we can see kind of what happened. I mean, it got halted to the downside, but now it's coming back up. So it doesn't seem like there was some huge fundamental change or shift in the news or anything. So we'll see. But all right, guys, like I said, smash the like, subscribe to the channel if you have not already. Peace and love.